Welcome back to the Strategic Investor Podcast. I'm Jeremy DeSpain, and today we are launching into one of the most powerful financial strategies for long-term investing, dollar cost averaging. Whether you're a seasoned investor or just starting out, understanding this strategy can make a huge difference in your financial journey. What exactly is dollar cost averaging? Simply put, it's the practice of regularly investing a fixed amount of money into a specific investment, regardless of its price. This means that when prices are low, you buy more shares, and when prices are high, you buy fewer shares. Over time, this can lower your average cost per share and reduce the impact of market volatility. Let's take a closer look at how this works. Imagine for a moment you decide to invest $100 every month in a particular stock. In January, the stock is priced at $10, so you buy 10 shares. In February, the price rises to $20, and so you buy 5 shares. But in March, the price drops to $5, and you buy 20 shares. But at the end of 3 months, instead of trying to time the market, you've simply invested consistently, and your average cost per share is lower if you'd invested a lump sum at once. Now, why is dollar cost averaging so important for long-term investing? First, it helps to mitigate the risk of market volatility. Markets can be unpredictable, with prices fluctuating dramatically in a short period. By investing consistently, you avoid the stress of trying to guess the best times to buy. Second, it promotes disciplined investing. It encourages you to stick to your investment plan, even when the market gets choppy. This discipline is essential for building wealth over time. In fact, studies have shown that dollar cost averaging can outperform lump sum investing in volatile markets. When you invest a large sum all at once, you're more exposed to the risk of buying at a market peak. Of course, dollar cost averaging isn't a one-size-fits-all solution. It's important to consider your individual situation. If you have a lump sum to invest and the market is at a low, it might make sense to invest it all at once. But for many, especially those who are new to investing, dollar cost averaging is a great way to get started without the pressure of market timing. To implement dollar cost averaging, set a specific amount you're comfortable investing regularly, whether it's monthly, quarterly, or even weekly. Choose your investment vehicle like a mutual fund or an index fund and stick to your plan. Remember, the key to successful investing is consistency and patience. I like to say slow and steady wins the race. Dollar cost averaging helps you stay the course even when the markets get bumpy. Before we wrap up, let's address a couple of quick, frequently asked questions about dollar cost averaging. You might ask yourself, does this strategy guarantee a profit? There's no guarantees in investing. It will help you to reduce risk, but nothing is guaranteed. Is it suitable for all types of investments? It's most commonly used with long-term investments like stocks and mutual funds, but you can apply the principle to other areas as well. Bottom line, dollar cost averaging is a simple yet effective strategy that can help you navigate the ups and the downs of the market while building wealth over time. By the way, if you found this video helpful, please hit that like button and subscribe for more financial insights and strategies. Thank you for watching, and remember, the content mentioned in this video are for educational purposes only. Make sure you seek the personalized financial advice from a licensed financial professional. If you'd like to learn more about my firm, Advent Capital Strategies, you can find my website linked in the description below. You will not remain motivated in your financial journey without a strategic view of investing, spending, and debt. There's more to life than money. Enjoy it.